Welcome back to Alberta Primetime. On tonight's Vocal Point, are some countries purposefully devaluing their currencies, and could it hurt us? And do we Albertans have a Goldilocks real estate market right now? We'll ask our Monday Money panel. Jane Alm is a senior investment advisor with Angus Watt Advisory and National Bank Financial. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. And Shafik Hirani is a director with Investors Group Calgary. Good evening, everybody.
Good evening.
Hello.
Shafik, as countries, including Canada, try to pull out of the global recession, some new policies, such as Japan's, for example, appear to be intentionally devaluing their country's currencies to boost exports. Why is this a concern, and are the allegations true?
Yeah, they're true. I mean, you know, they just, there was a G7 economic summit in Russia this weekend, and they didn't really address the Japanese currency devaluation. Japan's been in a really tough time for about a decade now, and they've had no growth, and they've reduced interest rates to zero. So the only real option for Shinzo Abe, the prime minister, is to really flood the market with cash, and that really is inflationary in the economy, and it does devalue the currency. But it's good for Japan because they start to export more, and that helps people purchasing cars and stuff like that.
So is there a downside for Albertans?
Yeah, you know, there's two real problems. Macro, like from a large scale, the U.S. owns a lot of Japanese currency, and if they devalue their currency, the U.S. doesn't have as much money to purchase Alberta's oil. And if you're an Albertan, you probably might have some Japanese currency or Japanese funds in your RRSPs. And if you do, you might want to take a closer look at your RRSPs, because even though the Japanese stock market hasn't changed, the value has gone down 15% since then. So
Russ?
You might want to take a look at that.
Well, the yen's gone down 13% the last 3 months, and their market's gone up 30%. Every major economy is attempting to do this. Ontario would love a cheaper Canadian dollar. Everybody's attempting to do it. It should just be one bullet in the chamber to help every economy, perhaps.
Did we see enough talk at the G20 summit over the weekend about bigger issues that the world needs to worry about, constructive conversations about reviving the global economy, or did this currency kerfuffle get in the way of maybe some meaningful strategies?
Oh, there's that word, kerfuffle. You know, talk is all we've seen from these major economies for, Jane and I were talking earlier, for 4 years, 5 years. Nobody's really making any inroads to the true issues here, getting people back working, getting the economy going again. So far it is just talk. And again, if they're actually doing some action, Japan's been in this mess for more than 15 years. So this surge is great for them.
Could our loonie and our Alberta export resources, the values there, be affected by other countries devaluing their currency?
Well, we have to understand that what the U.S. has done with their quantitative easing is they flooded the markets with U.S. dollars, which is also currency devaluation. That's already driven our loonie higher. And if it turns into a vicious circle where everybody's trying to devalue more and the U.S. is devaluing more, then the pressure is on our loonie to go higher, which means it's harder for us to export, whether it's oil and gas or manufactured products, because that means our products are more expensive elsewhere. Remember that currencies aren't set independently. They're set off exchange with one another. So if one goes down, one has to go up. Mm-hmm. They work like a teeter-totter is the best way to explain it. So it will have an impact on it. As Shafik said, if they have less money to spend, they have less money to buy our oil. However, if they're producing their own oil, they may or may not want ours anyway.
Shafik, some are saying gold could hit a death cross when we're looking at resources. Tell us what that is and how is it tied into this discussion?
Sure, and it's really close to this death cross. The death cross is when the spot price of gold, the 50-day moving average of gold, crosses underneath the 200-day moving average. And historically, that's been seen as a technical bearish sign. And the last couple of times it's crossed that, the gold spot price has dropped about 10% the last time and about 20% the time before. It's really close to that. Metals were down overnight. It's something that you really want to keep an eye on if you are one of the gold bugs and have a lot of your portfolio in gold.
Russ?
You know, from an investor standpoint, if you're a trader short-term, that's certainly going to have impact. But from a long-term investor standpoint, you look at gold 20 years ago, it was $400 an ounce. Now it's at $1,600 20 years later. That's 7.2% per year. my 25-year history, as soon as you get that comfort zone is 6 to 10% from your investments. Anytime you get beyond that, it's frothy, dangerous, whatever term you want to add to it. So it's right in the wheelhouse at 7.2%. Gold will certainly, for centuries, has been a marker for many currencies and economies, and likely will continue to do so. So short term for an investor that's savvy, looks at charts, very relevant. Long term investor, it will likely go higher.
And as far as gold in your portfolio, it should be a part of everybody's portfolio, a small part. But remember, it doesn't generate income. There's no dividends, there's no interest. So you're not going to have, you shouldn't have as an investor, all your money in gold. But it is a holder of value. So if we were to see high inflation, if we were to see things go really bad, whether it's in Europe or in Asia, then gold will act as a balance to some of that. So you look at gold and you kind of go, it's one of those things that you want to hold it, but you don't necessarily want it to go really high because that means other things are not so great.
Shafik, what else are you watching this week?
There's two real things on the market right now. The Japanese, with all this currency devaluation, Japan does not have a foreign finance minister and a monetary minister, and they've said the Prime Minister Shinzo Abe has announced that they're going to probably announce that this week, and that should do a lot for the Japanese currency. That's what we're looking for. It should be announced by Friday.
Russ, we're still waiting for the great rotation. Instead, we're getting the great vacation. Explain this trend.
So for 2 years, 3 years now, I've been having clients saying, when's this going to change? When's this going to change? But conservative
From bonds to equities.
From bonds to equities. But conservative clients have been doing very well, but all that's happening is there's cash going into equities. There's no change from the people that are invested in the safe, conservative bonds. They're not taking that conservative money and going into the aggressive equity session. So until that happens, I don't think anything is going to change from the equity standpoint.
So we've got volumes below normal. We've got traders sitting on the sidelines, worried about U.S. markets consolidating, a Europe recession, U.S. debt, gold and oil prices
breaking down. So again, until you start to see something actually change in the fundamentals, I don't see a lot of change. I mean, the markets have done very well if it's yield, dividend, REITs, which is the real estate investment trusts, or anything that's U.S. companies have done exceptionally well because of what they're doing with their currency and spending money.
So you're seeing 2013 so far as a mirror of 2012?
Nothing's showing me to be any different.
Jane, what are you watching?
Watching the election in Italy, which is going to happen next week. Silvio Berlusconi, who was the prime minister and got thrown out, we all know some of his escapades. Looks like he's in the running again. There's another gentleman that's in the running again, but he's involved with a bank that's having some issues in Italy. Mr. Monti, who was the technocratic Prime Minister of Italy, he looks like he's running in third. So we could end up...
And why do we care? Because of the European recession?
We care because Italy is one of the largest economies besides Germany and France. Italy came very close to needing a bailout. Their interest rates went very, very high. So if the election comes and there's no real majority winner, or the market doesn't like who that winner is, the interest rates start to skyrocket, puts pressure back on Europe, puts pressure on Germany that's already reported lower GDP, that has some issues of its own in an area where currency is very strong. So you've got a mix that could mean that the crisis in Europe becomes at the front of people's minds again.
We know what that does to our portfolios.
And we know what that does to our portfolios. And I'm also watching the pipelines because Enbridge has announced that they are going to partner with energy partners and turn a natural gas pipeline into one to carry oil. And this is into the U.S., into an area where there isn't a lot of oil pipelines. Now, why this is interesting is because it'll be the first time that they've actually turned a natural gas pipe into an oil pipe, but it will not carry bitumen, which is what we have. It will carry other kinds of oil.
So perhaps fewer protests over that one.
Perhaps.
Next up, too hot, too cold, or is Alberta's real estate market just right? For how long? The Monday Money panel is back with a Western Canadian realty expert to kick us off when Alberta Primetime returns in a moment.
We have to remove the emotions around this whole real estate market. It seems like now with the internet, blogosphere, Twitterverse, Facebook, everybody has a bullhorn. Not everybody has any experience, and not everybody has any information on how to analyze a market. As we look at the markets across the whole province, we start to see that it's almost like a university study. This is how a market should perform when. And it's not too hot, not too cold, but Goldilocks, it's just right at the moment. I don't know how long it's going to stay just right, because I think that the upward pressure is coming very quickly. I say in Alberta, you are going to outperform the majority of real estate markets around North America. And not because of speculation, but because of the underlying economic strength. People are looking for jobs, they're moving for jobs. We're at 4% unemployment. Try and find another region in North America, Europe, or Asia that has 4% unemployment. Alberta is going to be one of the most safe spots to have placed your money. How do I know that? Because the Europeans are coming here with giant checkbooks. And they don't care. They don't care about the politics. They're looking for places for safe havens, and we're living in it right here.
Welcome back to Alberta Primetime. Some thoughts there from real estate expert Don Campbell on the Alberta market. Shafik, numbers released by the Canadian Real Estate Association Friday show prices down across the country, including major centres like Vancouver, Toronto, but Calgary, Alberta in general, bucking the trend. What do you expect as the year progresses in Calgary?
The exact same thing, Jennifer, as Mr. Campbell said. We're in a wonderful environment right now. We have very low unemployment. We have a growing population. We have job force growth. We have companies making money. The rents are low. It's really poised for growth. At least in North America, Calgary, Edmonton seem to be the best two places to buy.
Jane, how about the potential for a not so comfortable boom? Well, too hot.
Well, the too hot would be if there's a lot of demand for oil sands workers and we have a lot of people coming in, and they're coming in without jobs waiting for them, without the ability to have a place to live. Then we get back to that too hot, because then you can't find people to staff the McDonald's or whatever.
But do you see that if we don't have our pipeline issue solved?
With natural gas at the price it is, not really. Don't see that. I think, when you're looking at real estate in Edmonton or in Calgary, a couple of key things to remember if you're looking at investing in it is make sure that if interest rates go up, that you can still afford the mortgage payments. You have to be able to, as Dr. Allard said, staying power, staying power, staying power. Make sure you can ride through any storm that comes. And the most important thing is, if you're buying a rental property, do you want to be a landlord?
Russ, your thoughts on investing in real estate?
What's important to me and my clients is how we make money at this. And everybody's not a realtor. Everybody's not going to own a rental property. From a standard investment standpoint, the average person can take advantage of REITs. We mentioned it earlier, real estate investment trusts. We've had 4 consecutive years of positive returns. Last year was 21.7%. No, that was 2011, 17% in 2012.
So let the hotels and big landlords do what they do best.
Let them do what they do best and look at adding to your portfolio. Is there a bubble? Again, you have to be cognizant of how much you're putting in and don't get carried away.
Closer on the horizon, counting down to the RRSP contribution deadline. It's March 1st. Shafik, so far 2012 contributions lower. Why?
People just don't seem to be as enchanted with RRSPs as they used to be. We see it in our clients right now. People are, have been said, I have never maxed out my RRSPs. I don't really believe it as a strategy for creating wealth, so I'm not going to do it, and I'm never going to do it. And I think people are just upset. And what happens is, the further we get away from this limit, the less we create it as a priority. And I think it's really a good time to reflect back on the value of buying an RSP. And I think, for your audience, I would encourage them to max out before the March 1st deadline.
Well, we're hearing less about the tax advantage.
But it's not just the tax advantage, and that's pretty short term. That happens that year. But where I'm really more focused is, you look at the number of people coming into our offices that have a group RSP versus a defined pension plan. In the old days, our parents had a defined pension plan. They had a pension for the rest of their lives. We basically have what we can save, whether it's a group RSP or whether it's matching contributions. It's our responsibility to take charge of what we're going to have to live on. We don't want to live on CPP and OAS. That may be government money, but that's pretty skinny living. You don't want to live on that.
Russ?
just to be the devil's advocate, I have to understand the way an RSP works. It's not a tax deduction, it's a tax deferral. And for many, it's a tax trap. So you have to understand how your pensions fall into this. If you're married, how the spouse's income brings into this. Just don't look at RSPs as the answer to all your financial woes. It's difficult to save in these times. Tax-free savings accounts are a fabulous way where perhaps you can use a blend of RSPs, take your rebates, go into a tax-free savings account, and also look at your debt. So you can have it all.
Lots of good advice from our experts tonight. Thank you. Jane Alm is a senior investment advisor with Angus Watt Advisory and National Bank Financial. Russ Dratwa is a senior investment advisor with Canaccord Wealth Management. And Shafik Hirani, a director with Investors Group Calgary. Thank you all.